every market you go into, every broker, every person in that market is going to say it's competitive, it's hard to find deals. And that's ultimately just, everybody's going to say that everywhere, regardless where it is. That's just what people say because it makes them feel better if they're not finding deals, right? So yeah, everywhere is the same right now. It's all busy, it's all overpriced, it's all hard to find deals, but we're closing on a new deal right after the new year. So they are out there, and this one was direct to owner, but you just have to do the legwork and you just have to continue to do the work. If you're going to look at one property and make one offer per year, you're probably not going to get many deals, and you're probably going to say it's a hot market. It's too hard to find deals.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth of Real Estate Investing podcast. This is your host, Dwaine Clarke, and today we have Jason Yarusi. Jason is a real estate investor and syndicator and founder of Yarusi Holdings in New Jersey. Jason is also the host of the Real Estate Foundation podcast and Multifamily podcast. Jason, thank you so much for joining us on the show. How are you doing, my friend?
Doing great. Thanks, Dwaine. How are you?
I'm doing very well. Really appreciate it. Not too far away. I'm here in Connecticut. You're over in New Jersey.
Yes,
and I think we had spoke before about that. And then I think we knew a couple people in the business that's kind of in the New Jersey market. So it's very good to talk to someone that's closer or talk to investors nationwide. So it's always cool to talk to someone that's a couple hours away drive. So
crazy enough to live on the East Coast, right?
Yeah, right.
Yeah.
Well, someone has to live here, I guess. So.
Correct. That's right.
But yeah, you have a huge platform. I listen to a lot of your podcasts and a lot of your videos. Excellent content. You guys are very active in the business. But for people who are not familiar with you, would you mind kind of talk about your background, how you got started in real estate?
Sure. Yeah. So Jason Yarusi, myself and my wife, Peely, of course, as mentioned, we're Yarusi Holdings. We invest in B and C assets, specifically in the Midwest and in the Southeast, targeted repositioning value-add assets, through syndication, just to, of course, find the value, improve them, and then better communities and along the way, help investors doing so. We've now created also a meetup here in New Jersey that services just for multifamily investors. It's called Multifamily Foundation. And as mentioned, we have the Real Estate Investing Foundation podcast and also the Multifamily Foundation podcast, where Real Estate Foundation targets all different forms and asset classes of real estate, and multifamily, as the name, focuses just on multifamily. Got our start a couple of years back, come from a family construction business, and we found that we wanted to find some other way to really just create passivity in our life, because we are just so active and the construction business was so busy. We're in a niche business where we move buildings, and it was so insane after Hurricane Sandy happened because of the onslaught of work that we were just looking for an outlet that could allow us to grow our family. We have 3 young kids under 5, while having some time away from the business. And we first, just like many people, jumped into flipping and wholesaling and realized very quickly that that was not a passive way to really get started with real estate or a hands-off way. And it took us some learning lessons, of course, just like anybody, but great learning lessons through flipping, wholesaling, doing Airbnb, investing in rentals here, and also rentals afar out in other markets. We were in Indiana, we were in Alabama, to just understand the model we wanted to. And once we were investing in these assets that were out of state, we said, man, it's working on a small environment for us 2, 3, and 4 units. What if we could scale this and do this on a larger capacity? And that's where we learned everything we could about investing in large multifamily, specifically through syndication. And doing that model, it's allowed us where nothing's ever passive, but we're able to be passive in a way of not having to get our hands dirty and running the asset properly by creating systems, creating processes where everybody can benefit from being able to do the role that they're best suited for. So we're doing our highest, best use. And instead of going out there and running to fix a problem with the property, whether it be a leak or others, we now have the teammates and team members in each market that is now better suited to do that.
Absolutely. I like how you kind of noted there kind of your highest and best use of your time. And a lot of time where people are kind of educate themselves on the different ways to get into real estate usually is just jumping in and wholesaling and rehabbing, and that's kind of a lot of hands-on type of thing. So of course a lot of people's goal is to get on the passive side, or at least the semi-passive side, where you set up a team like you had mentioned to be able to take advantage of opportunities, especially them being in other markets. Kind of talking a little bit about your business model. You mentioned like syndications. You guys are invested in other marketplaces. Can you kind of touch on, do you guys are like the sole sponsor, where you guys are finding the deal, taking it down, raising the funds, and hiring a third party manager? Or you guys kind of work with other sponsors in that capacity as well?
So we do actually run the entire asset management. So we are the sponsor on the deals, and we do use third party management. At one point, I just want to jump off is that we did try out a lot of different forms of real estate before we jumped into this. And I think it's important. There's a fine line between actually learning everything you can about real estate or the specific asset class you want to be in terms of real estate, and actually doing it right. So that if I wanted to be a flipper, and I spent a year learning everything I could about flipping and haven't done anything, then I finally taken my first project and quickly realized that I hate everything about flipping. It would be a poor use of my time. So there's a fine line where you can't sit in the sidelines and wait to find anything. You have to get yourself active to really just see if you even like that space before you move on, right?
Mm-hmm.
And that was part of our learning lesson, is that we were able to learn what worked and what didn't work, and adapt, and what did work and we did like, we were able to grow the processes. And then for, of course, large multifamily, we aligned ourselves by finding the right partners in terms of mentors that could help guide us, where we did everything in terms of find a deal, find the equity, securing a loan, closing on a property, sourcing our property management company, creating all of our contacts, going together with the property management company to create our repositioning plan, and now, of course, doing the asset management for the property. That is good to start with, but we've now grown that we're continuing to bring on other resources to help us underwrite deals, to help us now investor liaisons, because as you grow, it's not always ideal to do every part, right? Especially if you're going to bring on capital from investors. You want to make sure that you're doing what's most important for the project, where wearing all these hats gave me the ability to learn the roles, but there's a lot to do. And there's a lot of parts where it can move quickly and things can fall off if you're not able to, of course, conquer everything at the same time. So as we've grown, we've continued to find pieces that help us along the way, find team members to help us along the way so we could scale efficiently.
That's very nice. I like that a lot. So currently you guys you had mentioned like Indiana and I forget the other market, but currently, like I said, most of your holdings are, you say, Kentucky and another market. Can you talk about
Correct. Yeah. All of our smaller properties that were in Indiana and Alabama and New Jersey, we actually sold off.
Mm-hmm.
And now all of our large multifamily is split between Kentucky, Georgia, Texas.
All very nice markets.
Majority of our holdings are in Kentucky.
Yeah, I've talked to a couple investors, like especially in Indiana and Georgia. But can you kind of talk about Kentucky? What drew you there? What are some of the characteristics of that market that's very attractive for investors?
Sure. So you always want to look at it at a high level first. Is there a market that's within range, right? If you can't invest in your local market, because I'll find people want to jump out of their local market without really any true indication why. Where your local market might be the best place for you. And just because it's far away doesn't make it the best choice. So we knew that New Jersey doesn't work for us for a number of reasons. High taxes, older properties, eviction laws, rent first price. There's so many factors here that would limit you from investing proficiently and having our money go as far as it can. So we started looking at other markets. We sourced markets down in Texas, markets in the Carolinas, and Kentucky. Kentucky was actually our third choice. And we evaluated markets based on a number of different metrics, but on the high level, it's, of course, MSA of over 250,000 people, population growth, job diversity, a number of assets that are actually available in the type of product we're looking for. So if I'm looking for 75 to 150 units, I want to make sure that there's a number of complexes that can meet that. It's not like a Provo, Utah, where there's only 3 complexes that are large multifamily, right?
Mm-hmm.
Where it's going to be very difficult to get into. And beyond that number, new construction, how many units are coming online compared to what's the saturation rate, how much is going to be absorbed over the next 3 or 5 or 10 years. And also in the submarket specifically, which submarkets are going to be best appropriate for the type of assets I'm looking for. Blue collar, working class properties. Where are those submarkets? Because in any market you can find, of course, multifamily properties, but I don't invest across for Louisville, Kentucky. I don't invest in the entire market. I invest just in certain submarkets that fit those dynamics.
Oh, very nice. What kind of like, far as kind of finding deals, especially in new markets, you being in New Jersey, is it you built up contacts over time? Is it, contacting your local property managers? What's like been working best for you guys?
Sure. It's always a mix, right? Yeah, brokers are, of course, the lifeline. You have to have brokers. They are the ones that are in there. They have the market knowledge. They have the contacts. They have the resources. And unlike, of course, single families, they have a lot of pocket listings where deals will actually go out to buyers that will never hit the market and be sold basically off market just as a pocket listing through the broker. So you have to have that connection. Of course, now, today, these days, and just where we feel we're at the market, you got to find a number of different ways to also find properties. We do find that property managers have been great. Property management is one of those games where it's kind of to me, a fruitless business, because if you do well, people sell the property. If you do bad, then you get fired. So somebody in between, but there's a lot of other rangers. So if there's an owner who may be at the end of the life of their hold, or may not have put enough money aside for CapEx, or has had a partnership disagreement, well, they may be looking to sell. And if that property manager on that property is now going to lose that client, it would be in their best interest if they could actually find another client to come in there and buy the property, so they, of course, can keep those assets under management for themselves. So we have had a good sense there. I've had property really come over from a number of different facilities. Just connections I've made. You can also talk to, we've had now insurance agents send us properties. I've had a cost segregation person send us a property. I've had friends in the area send us a property. So it's not so much that you never know where your lead's going to come from. It's just talking about what you like to do in that specific market. And the more you talk, the more you find those opportunities will just happen to show up.
Absolutely. And then you kind of mentioned, as far as kind of like finding stuff, how do you see kind of now, has it been very competitive in that market? I know you said you're looking at kind of sub-markets, kind of maybe outside of Louisville, maybe some other marketplaces maybe less competitive, but will deliver, the investment results that you're looking for. But how do you kind of see how the market is right now as far as competition with other investors?
So we have some mentees that we've taught this process, and I explained to them that every market you go into, every broker, every person in that market is going to say it's competitive, it's hard to find deals. And that's ultimately just, everybody's going to say that everywhere, regardless where it is. That's just what people say, because it makes them feel better if they're not finding deals, right? So yeah, everywhere is the same right now. It's all busy, it's all overpriced, it's all hard to find deals, but we're closing on a new deal right after the new year. So they are out there, and this one was direct to owner, but you just have to do the legwork, and you just have to continue to do the work. If you're going to look at one property and make one offer per year, you're probably not going to get many deals, and you're probably going to say it's a hot market, it's too hard to find deals.
Absolutely. And can you kind of take us maybe just like a brief case study of like your most latest deal in that marketplace, and then kind of talk about how you found it, and maybe like the future plans for maybe like just a brief description of the business plan?
Sure. Yeah. So happened to be one that was much smaller than we were targeting. 32-unit townhome product. And it was a probate deal where the owner had died, and what we thought was his fifth wife was actually his sixth wife had the property.
Wow.
So that a story. Property management knew of it, and they had this property, and it was outside. Basically, they had a number of properties that were closer to downtown, and that's also where they lived. And this was a property that was outside of, there's a 64 highway loop and a 264 highway loop, and it was outside of the secondary loop right there. And it was outside their comfort zone. So they wanted to sell this property, and we went in there and put together an offer that worked on the numbers that said it was actually 98% occupied when we went under contract with the property. But when we got to the inspection, we had found out that they actually had 9 vacancies And we were going agency debt on this. We had it all lined up and everything was at point. So we don't look to retrade, but I went back there and said, listen, this is just not what we agreed with here. So we had a restructure pricing, but we were able to create an agreement where they had basically taken their eyes off of it because they just, once the owner had passed away, it just wasn't their core competency. They didn't know how to handle this type of tenant base, and it was just way outside their scope. So we actually made an agreement where our property management company actually came in pre-closing and was able to take over on the asset on the management side of it, turn the units, get them leased. And the good news, it was actually all the turns up to something low 40 thousands total was covered by the owner, by the current owner. And we also, instead of leasing those at what was the actual rents for the other units, leased them at market rate. So I walked into the property, instead of walking in at the in the 70% range for occupancy, walked in over 90, was able to secure really attractive agency debt. I think we have 2 years IO, 10-year fixed, very low interest rate, amortized over 30 years. A property that was showing already the business plan, because we were going to go in there and renovate units and bring them to market. Well, now we walk in showing 8-9 units already with the business plan proven.
Wow.
And it's been cash flowing since day one. So it's an incredible property, rolling there, just continue the business plan. We're actually now leasing up. We were doing them all on classic turns, basically a bronze package. And now we're going to change up some of the renovations since we have hit our target rents, and try, there's a stage of premium upgrades that we're going to do, of course, cabinets, so countertops, flooring, vanity work that we're going to do for upcoming units, and see if there's a threshold. I think our rents right now are $750. We should be able to get $850 to $865 with that next stage, but that's coming off before, where we had a mix of $625 to $725 between the units. Now we're going to have a substantial rent bump just walking in there. And the other side of it is we had a green loan where we're able to do a bunch of green repairs. They gave us a course credit on our interest rate. It's also made the property more efficient. We should have a 15% savings across the board on our utilities. And then some of the angles we also did out there is, most of it was, it was in very good shape, the property, which was one of the reasons we went after it, because noting 32 units, not the most efficient from a management style, but noting that we have a management company where we already have a couple hundred units in the area, we're able to maximize off the efficiencies already having pre-existing assets. Plus they have a south side office that we're able to run leasing out of, that's right down the block.
Wow.
Number of things that worked in our favor for that one.
Wow, that's awesome. Yeah, and like I said, you had mentioned that you're doing getting in those lease ups there, was able to kind of cut down as far as kind of the business. But is that going to be a 3 to 5 or a little bit longer term? Is a smaller deal, or?
I've been positioning it for all investors right now that we are targeting 8 to 10 year holds.
Wow.
Now I'm putting it that, and I'm putting on longer term debt, having reserves, having cash flow. And I tell investors that if I find an offer from, of course, a buyer early in the process, we have the ability to choose our best route. I don't want to tell people a 3 or 5 year hold, because I don't feel like that gives us the best opportunity, if I'm putting on debt where it's a 5-year term, to be in the best position to choose our outcome. Because noting where we are in the market, I don't have a crystal ball, but if you think potentially 2-3 years from now, will we be in a better economic environment or worse? Noting how high we are, it's probably going to be in the opposite direction, right? Interest rates might go up. There might be a number of things. But if I tell people 3 or 4, 3 to 5 year hold, I'm really having to sell instead of making the best choice to choose to sell when I want to. So now this gives me the best play. I could, if times continue to be great, I could sell it. I could refinance it. If they don't, I could have, I have that couple years buffer right there to go in there and now wait it out and do whatever we need to sell it at that 8 to 10 year mark. However, we did buy it. I think we're at $50,000 a door, and we already have offers in low 70s a door because of
awesome. So. And as far as kind of like the other 100 units that you have in the marketplace, is that something like, like a lofty goal of maybe collecting maybe like 1,000 units in there and then maybe selling to like a large buyer down the road? Or are you just going to be seeing them at each deal at a time and check out which opportunity plays well at that time?
We'll have about 300 in that market after we close this next one here. And that's always a thought, is having to know your end buyer. Noting that we're a mix of a couple different size properties, the institutional buyer would probably not be the best approach at this time for us, just because it's a mix, right? It's not
Mm-hmm.
just generally you're going to look at 150 units and up, and this is a mix between 94, 106, and then 32 to 56, 48. So it's a mix of different property sizes there, but you always do want to look at your buyer pool when you are doing this, and that goes on a market side. Like, so if you're in a tertiary market, who's going to be in your end buyer? If a institutional buyer can't fly there direct, they're probably not getting in the car after 2 flights and then driving an hour to get your market. But if you're in an area where it could be a tier 2 market, what size properties makes the best sense for someone who's just looking for buying on cap rate or looking for a yield play? And that's usually going to be a larger asset, because that's where you can get your most bang for your buck, because people need to put money to work. If not, you're going to be more allocated to that local investor or another investor who may be looking to buy at a price per door. So 2 different things. You're either buying on where your NOI is, or you're buying on a price per unit for that buyer right there. So that's a good question. Noting who that person is really going to help you when you're buying the asset, because you have to think about, all right, I buy this, who else is going to want to buy this from me?
Mm-hmm. Awesome. Yeah, that's a great detail. I love that. And thank you for breaking down that story. We kind of mentioned a little bit before in the pre-call about you working with your spouse team and things like that. I'm seeing like a couple groups that's doing that. I think that's excellent. How does it, how's it working for you as far as kind of like roles and stuff like that makes it work great for you guys?
So Pili and I met actually working together. So it's always been ingrained in how we've known each other. And just understanding roles and understanding functions is hugely important, right? And just communicating. I find that where the disagreement comes between partnerships is lack of communication and lack of clear focus on who does what.
Mm-hmm.
Everybody kind of does the gray, and then when things don't work out, there wasn't really a clear black and white of what they were supposed to be doing. So there becomes a lot of blame being passed around, because everybody thinks, or in their mind thought, that it was somebody else's responsibility, especially when you're working with family too. If you're not putting things on paper, someone may say, well, I don't want to write something on an agreement on paper with my family, because that just seems weird. But what seems really weird is that if you're going to have a conversation 5 years from now about what you agreed to today, and there's nothing in writing, everybody's going to have heard the story a little bit differently.
Mm-hmm.
And that's where agreements become fights, and that's where families break up, partnerships break up, and everything becomes chaos. So be very clear who does what, and communicate. And it's on the opposite end. To create your own business, it's a difficult thing, because you're creating something that's more of a selfish environment, right? Because we're doing this for us to really help others, but it's our needs. So if you are having a partner or a spouse, or in some capacity that's not working with you, you want to ask what they want from this partnership, how they see it, where you can help them along the way too, to better understand it. Because if you're just saying need, I'm doing this great thing, that the spouse may not see it this way for so many different reasons. Maybe you're not spending as much time with the family. Maybe you're not having the right headspace when you are with the family. Just so many different reasons, because you haven't had that conversation.
Awesome advice. Yeah, I love that a lot. Yeah, that's we talked to a lot of partnership teams, and like I said, they break it down the same way. And like I said, you guys are having a tremendous success. So thanks for that. I really appreciate that. You guys been growing your meetup group locally in New Jersey for for many years and stuff. Can you kind of talk about what you got? How long you've been running it? The types of discussions and things like that, and how you're able to help investors locally.
Sure. So yeah, it's been a little over 2 years now, grown to about 2,000 members. We found that there was nothing specifically targeting multifamily investing. So we filled that niche. Most RIAs or meetups are just covering investing across the board, and 1 month to the next month is completely different. So we dive all in multifamily. That's all you're going to get here. It could be investing in New Jersey. It could be investing out of state. It could be how to raise capital, how to underwrite deals, how to find markets, how to find your team members. We cover something different on each meetup, We'll have speakers at certain meetups. Anybody's welcome. It's a free meetup. We do it here in Westfield, New Jersey. And we just like to get a great community together. It's a mix of people who have done a ton of multifamily work and people who are just trying to learn more. And it's a mix of active and passive investors. So it's a great room, lots of great questions, a great community, and just really, it's been amazing to see the entire community grow.
Are you guys doing that like once a month, or you guys meet a couple times a month?
Yep, we actually do it once a month. It's generally the second Tuesday of the month. It's, to me, that's a good part. It gives us time to really capacity, and things are just so busy, but that once a month is great to get everybody together.
Exactly. Yeah. And then also you have 2 podcasts. So your main one is Real Estate Foundations, and then the newest one is Multifamily Foundation. Can you talk about, what people can get out of that, and when is it air, and, things like that?
Sure. So Real Estate Foundation has Wednesday long form interviews that come out. We're on like episode 460 or something from that point. Had amazing people on there providing a ton of guidance. It's really just following the steps and missteps others have taken to really create a successful real estate business, just to help people get off the sidelines and get going. If they are active, finding tools that can help them grow their business. And then Multifamily Foundation is, of course, like our meetup, everything targeted for multifamily. We actually have a Monday that Peely covers moms of multifamily, because there's a lot of women out there that are out doing it, that have small children. How are they growing their business? Friday dives just core into the business of your business for real estate, techniques that you can do just to grow the business side. And then Tuesday, Wednesday, Thursday, focus on everything there is about multifamily from all different capacities, just like we talked about the meetup. We may be talking about mindset. We may be talking about underwriting. We may be talking about team development. We may be talking about sourcing capital. So we will cover the gamut. It's 5 days a week, Monday through Friday. Find us iTunes, Stitcher. I mean, all the major platforms, you'll find us.
All right, beautiful. Yeah, just so you talked a lot about like kind of like technical stuff and like your business model is great. Can you talk about like, your typical work day, and like, and do you have any special morning routines? Of course, like I said, execution, and of course behind the scenes is like the biggest work. You can learn all that stuff, but it's learn to kind of see what you do that works best for you.
Yeah, you learn over the way that more sleep, even though I'm still working on that, is very important. I try and go to bed anywhere between 10 and 11 at night. I get up at 4:13 in the morning daily. I do a morning routine, meditation, just silent time, super important. Just get your head straight. Affirmations, some form of this, however, it's the savers I do. I work out every morning. I'm a big runner. I just ran a 100-mile race 3 weeks ago, but I do a ton of running, probably a couple 100 miles. I usually target about anywhere between 125 to 200 miles a month. So just putting a lot of miles to work there. And that just allows me to clear my mind. And then past that, I do some brain games, and then I get after it.
Nice. And how do you kind of balance everything with the family? I know you say you got 3 kids and stuff, with the work, and then looking at new ventures and podcasting and running and working out. And how do you kind of make it all work?
I find balance is a loaded word, because you're never really, you just can't, right? So if I'm balancing family and working out and underwriting deals, I'm really getting nothing accomplished. So the one thing I've found is that when I'm there, I need to be there, and be there with intent. So if I'm working out, I'm working out. If I'm with my family, I'm with my family. And there's just so many ways that can fail across the board if you're not actually there. So if I'm with my family, but I'm on my phone, sending text messages or doing something else, am I really with my family? So being there with intent for what I'm doing, and not feeling bad when I'm doing something else. So if I'm with my family and I'm feeling bad that I'm not doing work, then I'm not doing the right thing. If I'm, working out and feeling bad I'm not with my family, then I'm not really doing the right thing for my workout. So having the capacity of just saying, okay, this is my time to do this, get it done efficiently, and then move on to the next thing. And that's been the best form of balance I can find, because I don't find that balance usually aligns.
Mm-hmm. Awesome. What do you say that you're most grateful for?
Family, healthy family. And that's just every day. I just am grateful that my family is healthy and happy, and couldn't ask anything more.
Very nice. How do we get in contact with? I know that we, you can look on Stitcher and iTunes regarding your podcast, but how else can you share some more contact information to get in touch?
Yeah, absolutely. So you can find everything about us, our platform, our meetups, our podcast over at yarusiholdings.com, YARUSI holdings.com, and go to Jason at yarusiholdings.com to send me an email and just connect. Love to hear from your guests.
Awesome. Jason, it was really a pleasure to speak with you, and finally got a chance to talk to you. We've been trying to get our schedules aligned, and I'm finally glad we was able to do it.
Me too.
Like I said, look forward to hopefully be able to meet you soon down in New Jersey at some point. And again, the holidays are coming up. Have a blessed holiday, you and the family, and we'll look forward to connecting with you again soon.
Thank you. And I know how much work it is putting on a podcast, so I appreciate you doing this. Appreciate you putting out this great info for all of us. Thank you.
It was my pleasure. Thank you so much. We'll talk to you soon.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.